Hello, welcome to NAIFA Live. I'm your host, Zach Hewells. We are very excited to be broadcasting live today from our host chapter, NAIFA Tampa. This has been a fantastic year of NAIFA Live. We've had great support from watch parties all over the country. Today, we actually have watch parties in Iowa, Louisiana, Maine, Minnesota, Missouri, North Dakota, Ohio, South Carolina, Virginia, Washington, and Wisconsin. And Ohio has their first ever watch party today, broadcasting live from the Lifetime Financial Growth Office in Columbia. Welcome all watch parties. Thank you so much for being here. Now, November is Long-Term Care Awareness Month, and we have dedicated this month's NAIFA Live meeting to focus on providing education on the many funding options available for limited, extended, and long-term care. We also want to help you get the conversation started to include care planning into your consultations with clients. Now, long-term care may not be widely discussed, but it is crucial. Chances are your clients are not discussing potential care options for their loved ones. We want to ensure that NAIFA members understand the wide world of long-term care. And that's why we've created the Limited and Extended Care Planning Center, or LECP. Thanks to the funding from all of our founding sponsors, we've been able to cultivate a variety of resources from industry experts to help you every step of the way. Now, we'd like to take a moment to thank all of our founding sponsors. The LECP is specially designed for advisors, and it is completely free. You can subscribe online at lecp.naifa.org. And thank you again for the sponsors. Well, of course, we could have not done any of this without the expertise and guidance of Carroll Golden, the Executive Director of the LECP and your featured speaker for today. But before I turn it over to our friends in Tampa, I just have a few housekeeping items to go over. Today, 1 CE credit has been approved for participants in Arkansas, DC, Illinois, Iowa, Maine, Nebraska, North Dakota, Virginia, and Washington State. For those of you joining us virtually from those states with the intention to earn a CE credit, you must remain present for the duration of the program. Throughout the program, polling questions will appear on your screen. You'll have 2 minutes to answer them in order to attain CE credit. The first polling questions for individual viewers is, what state are you viewing this program from? I'll repeat that. What state are you viewing this program from? Please use the polling function on your screen to respond. You have 2 minutes. Now, please save the date for our next NAIFA Live broadcast scheduled for January 9th, featuring Curtis Kersey, hosted by NAIFA Ohio and NAIFA Cincinnati with support from Emeritus. Registration is going to be now available today at live.naifa.org. Register early as we kick off our 130th anniversary of NAIFA. You won't want to miss it. Our incoming NAIFA President, Cammie Scott, will be there live and in person. Now it is my pleasure to turn the program over to NAIFA Tampa President-elect Patrick Garabrandt, who will introduce our speaker, Carroll Golden. Patrick, take it away.
I'm up here with Bill Bram, and I just want to talk a few quick minutes to tell you about our sponsor today, which is Transamerica. I have Kate Wild here with me, and I'm sure she'd be more than happy to answer any questions or talk to you about any opportunities that you might have after this event. Transamerica is proud to sponsor this event in partnership with NAIFA. As a leader in long-term care planning space for more than 32 years, Transamerica's heritage and history runs deep, serving clients. The individual long-term care division is the cornerstone of the long-term care lineup, and while there are several other products that help round out Transamerica's commitment to the industry, from living benefits on annuities to term life insurance with an LTC rider to worksite products, all of these offerings are designed to give long-term care protection to our consumers. Transamerica's standalone long-term care product has experienced good growth in 2019 and is well poised as we move into 2020. I want to tell you about progress in a couple key areas, just a moment. First off has been the expansion in the multi-life platform of long-term care for Transamerica. They expanded their distribution reach into the benefit space. So those of you that work with business owners, I hope you will keep Transamerica in mind. They've extended discounts more broadly, and they've modernized how cases are evaluated and approved to streamline that process. They've seen several key collateral pieces, some of which I put there. You're gonna find a protection you need on each of your chairs. It's just a nice, clean, one-piece handout for the consumer. In terms of marketing and sales support, the Denver distribution hub has seen growth. They have now have a dedicated desk just for long-term care sales and marketing. And why is that? That's because they want to be there to answer your questions and have some dedicated resources for you. You may have noticed that several Transamerica pieces this year have come with updated imaging and logo and branding, and you're going to continue to see those roll out as we get in through the 2020 quarters. Long-term care planning remains one of the most client-requested topics and often represents the largest single risk to those consumers that are entering retirement. Unfortunately, there are less and less people today that are specializing in helping in the long-term care industry. Despite a growing and aging population, a marketplace that really has more products than ever, there are roughly 20 to 40% fewer agents focusing on long-term care than there were even 5 or 10 years ago. And Transamerica believes that part of the solution for that, of course, lies in you, but it lies in reintroducing clients to the most affordable and approachable solution, which is standalone long-term care, right? For most individuals and families, a traditional long-term care product is still the solution that provides them with the most leverage. On your table, there's a couple other pieces I want to talk to you about. I talked to you about the protection you need. That's the one piece. I will email out to everybody that's on this program. Also, a work site and a multi-employee package that walks through all of Transamerica's lines. It's a detailed resource to help you identify and to help you present Transamerica multi-life solutions to employer groups and, oh, by the way, to associations. Their suite of products includes funded plan choices as well as voluntary offerings. That's a question we get. And there are discounts and underwriting concessions, which will, of course, vary from case to case. During November's Long-Term Care Awareness Month and beyond, Transamerica wants to wish everybody in this room and that's watching this video all the best. They're so pleased to see that the speaker for today is Carroll Golden, a longtime senior leader at Transamerica, a knowledgeable expert in the industry. And according to Matthew Hammond in their Denver field office, he wanted me to personally let you know that he feels that you are in very, very good hands today with Carroll. So let me talk a little bit about our speaker. Carroll is a forward-thinking organizational consultant, a business strategist with a diverse background. She's held several senior leadership positions within the healthcare and within the insurance marketplace. She's recognized by her industry peers for her continuing contributions to long-term care insurance, and she is a frequent speaker and noted author across numerous professional benefits associations. Please help me in welcoming the Executive Director of the Limited and Extended Care Planning Center at NAIFA, Carroll Golden.
Thank you. Thank you, Pat. Well, good afternoon. I don't think I was nervous till I heard all that. And of course, now I'm determined to bring up a script so that I don't ramble on you. I need the, oh, I see it's right here. Got it? Okay. Okay, so quickly, I'm hoping today that we learn a little bit about the current state, review the scope of the problem, hopefully gain some insights, and then learn some things that we can really take action on this topic. So what I want to do is first review who's actually affected by long-term care. You know what the issue is here, moving this, and I'm clicking this and shoving that. So men and women, they're equally able to experience a long-term care incident, even though a lot of the women traditionally lived a little bit longer. There is maybe 70% of us who, as we mature, will need some help with some kind of long-term care. And then, of course, there's the family and friends. This doesn't happen in isolation. Everyone in the family is affected. And the caregivers. We could do an entire presentation on the effect that the caregiving has on the client, on the person who's experiencing it, on their abilities to save for retirement, let's say, and on the workforce. And then what's next for the spouse? Well, just last week, the Society of Actuaries long-term care section put out a study, and it's the first time I've seen this topic. It's on contagion. And what it says is that after the first spouse experiences any kind of long-term care need, the partner or the spouse who isn't ill is 4.5 times more likely to need some kind of care within 1 year. So it has quite an effect, and they're going to continue that study. Let me just say now that we'll be getting to the very final slides where I'll be giving you the resources for all of the information that I'm giving you, because I'm a researcher as well as a person who's had a career in long-term care and obviously sold long-term care insurance. But I wanted to be able to offer you any of the research or any of the ideas that you're hearing about in case you need it and you want to review it. So also the community services are very impacted by this. I think your practices, you have to admit that you're hearing more and more about long-term care and extended care, states and the federal government. So this is going to be, and I hope that I want to thank all of you for coming today. And I also want to thank all of the chapters that are holding the chapter watch parties, as well as individuals tuning in at home. So I'm going to ask Bill to keep an eye here, and I hope someone at the other chapters does the same. Just with a show of hands, which generation do you think is the most affected by extended or long-term care? Hands for baby boomers? You're watching. I'm Gen Xers? Ah, interesting. Millennials. What do you think has it, Bill?
I think Gen Xers.
And Bill thinks that the Gen Xers have it. Well, I think most of you have heard that 10,000 baby boomers are turning 65 every day. And we can now update that statistic to say that 10,000 are turning 70 every day. Therefore, as we go through this presentation, we are going to get to non-insurance options because they may be beyond what we're used to offering them. As for the Gen Xers, according to the US Census Bureau, by 2020, nearly 140 million people will be over the age of 45. And frankly, that is a prime market that you should be talking to about long-term care, extended care, limited care. For the millennials, where they run into trouble is that in the year 2020, there is 3.5 working people. Did my mic just go off? Oh, there are 3.5 working people currently, but by 2060, that number drops to 2.5 working people. And I think we all know that while they're working, let's consider that there is currently now in 2019 a severe shortage of qualified caregivers, home care aides. So can you imagine by the time that there are fewer people working, how we're going to manage not to completely either run to taxes or, you know, run to having fewer people able to be at work, earning savings. So I think my whole point here is this scope is not just a statistic. This is our reality. So, more participation, not letting you fall asleep. Okay, we're gonna stay with it. So do you think the average, what do you think is the average number of years that people use extended or long-term care? Again, show of hands. 3 years. A few of you. 5 years. I think 5 years probably will have it. 8 years. Okay, now I have one more before I give you the answers to that. Where do you think they're going to spend most of their time accessing care? Nursing home, and I hope the chapters are doing this and somebody is counting out too. Nursing homes, assisted living facilities, at home. Oh, got the right answer on that one. So here, as you can see, that any service, it was 3 years, not 5. Okay, interesting. And I want to point out, though, look at the percentage. Sorry about my back here, but look at the percentage of people. So that's that number we keep hearing, that 70% of people are going to need some sort of care. And then my other question was, where are they accessing it? And of course, this brilliant group, you did get it right. It is any care at home, about 2 years. So the fact that it's going to be care at home leads us to another thought. This only came out 3 weeks ago. So this is a very updated version of the differences between 2004 and 2019. And you'll notice the total increase in assisted living, 70%. And how about the home care, home health aid? Rather a mouthful, isn't it? So that's up 25%. We just said most people are going to want to access care at home. I'm just going to let that sink in for a minute, because as you can see, you really do need to be discussing this with your clients. Now, I did bring up Florida because this wonderful chapter was nice enough to host me. And you'll notice that for Florida, compared to maybe the East Coast to the West Coast, although Alaska costs the most in terms of care, you can see that on a national medium where you are, the cost of care, this is monthly. So if someone is complaining about assisted living care, that's costing them maybe 4 to 6, because this is a medium, okay? Now, if you're paying a monthly cost for insurance, okay, exactly. I can see by your faces you're making all the right conclusions, that we really have got a way of telling a client, this might be something you should consider. Now, we have done the scope of the problem, so now I want to talk about what we have been successful in actually motivating a client. Most clients were told statistics 10, 15 years ago in the market, but long-term care and extended care has gotten away from using statistics to influence the sale. Now it's storytelling. Why? Because they will tell you what is important to them. As my kids always remind me, Mom, you have one mouth, 2 ears. So try listening, because when you listen, you find out what it is that's important to them and how the product solves the need of how to protect what is important in their story. So I want to go a little bit more into some details on that. So know your client. Okay, so for the personal support system, what do we hear a lot? Oh, my family's going to take care of me. Now you're having a conversation. Really? Where do they live? Oh, are you moving there or are they moving here? Financial picture. It is important for you to differentiate when they're talking to you about what is an asset versus what is income. Because some of the solutions or options that we're going to go through tell you that some people have the assets, but they don't have the cash flow. And they really are in a terrible situation. And I see some people nodding their heads because they have the asset, but they don't have the income that they need. So it's important for you to figure out which is true for them. Risk tolerance. Well, obviously, and I have definitely lost my place here. Obviously, for a client's risk tolerance, Since you're probably selling them insurance, investing things for them, you kind of know, do they take large deductible or are they risk adverse? Do they want to invest in something that's maybe a little riskier, or are they pulling back and they don't really want to risk? You're gathering all of this information. You haven't said a word about long-term care or extended care or limited care insurances. You're just knowing your client factually now. What about their advisory picture? They may have been the decision maker when it came to car insurance or when it came to life insurance. But when it comes to this, do they want to consult with the person who manages their money? Do they want to consult with their CPA? You have to find out, when it comes to these sorts of things, who do they speak to? What about their health history? Well, in terms of their health history, what you're going to have to kind of ferret out is, again, a conversation. How's your dad? Oh, he's fine, but my mom, or gee, my brother. Are you listening? Because all of these storytelling, all of these conversations are telling you what is important to them. Plus, if you hear about Alzheimer's, okay, now that's one that you're really going to have to pay attention to, because that could be a little longer claim than simply the average 3 years. Oops, sorry. I'm always rushing along, which is why I should be looking at the script, right? But let's go to knowledge and understanding. I think most of us will admit that what do we hear most about in the news when it comes to long-term care? Rate increases, negative press, which is too bad because that's what sticks. What you need to find out is if they're Google smart, which is dangerous, right? If they've heard from somebody else about the terrible rate increase. You need to have an answer for those things, but you need to know whether it's hearsay, Googled, factual. What about retirement picture? Do they have any idea what the impact could be if they did need long-term care on that retirement? Probably not, because when they think about retirement, they think about collecting the assets. It's not about how to generate income necessarily. And when they get to that point, they're usually in their 60s. Remember that the Gen Xers is really our primary market. From 45 to 60, chances are the underwriting is going to go a little bit easier for you. After that, you want to know that they are very healthy and that they'll be able to pass underwriting. Why? You don't want to disappoint a client, especially because as we continue talking together, you're going to see that we're going to cover about 15 options. 15. So there's no reason at all for you not to start talking to clients about long-term care. And as I will say at the end, you should be recruiting people. This is something that you can add to your practice through a little bit of education. Now, what has really worked in our industry in motivating clients? Well, you don't know exactly in their story what it is that they are going to really worry about. But in terms of invasion of capital, because remember, many of these people will have a partner, will have a legacy that they want to leave money to the family. Some of them will have a spouse. Some of them will have a brother or sister living with them. So when they think about invading their capital, it really disturbs them. What about tax consequences? I'm personally super sensitive to tax consequences. So I arrange my things the best I can not to become involved with tax consequences. We'll see later when we go through options, there are some ways that you can talk about tax consequences. Market timing, the impact on retirement planning. Did it go? Yeah, it went. Sorry. And then, you know, personal determination. That's some of the older way that we used to talk about long-term care, that you can't pick where you're going to be, you can't pick the type of facility. For me, I used to say, when you first went to college and you were in a dormitory, you had a random roommate. Well, that wasn't so hot. But when you're old and cranky, no, this is not going to work. This is not what you want to have happen to you. What about their children? As I said, you can do an entire presentation on what it does, because there are a lot of information on promotions being passed, people presentivism, the effect on the work site of having children who now have to take care. I think Bill and I were talking earlier about the boomer generation. They were called the sandwich generation because they take care of their parents and their children. Well, for the Gen Xers, Bill and I decided they were the club sandwich generation because they have the parents, the grandparents, and the children. So things are really starting to heap in. And they're trying to save for their own retirement. They're trying to figure out their future funding needs. So we want to align the client motivations with options, okay? We've seen the scope of the problem. There's no reason everybody shouldn't be interested in the topic, personally, professionally. We have seen that you are able to bring this up. I don't care what part of insurance investment that you're in. It's a conversation, and you already should be talking to your clients about these things. They're talking to you. You're just not hearing it in terms of how else you can help them. There's no such thing as a perfect solution, and long-term care options, shall we say, are like any other option. You need to know what it does. You need to know what it doesn't do. You need to know when it does it. Well, for life insurance, that's a pretty definite, right? Not so with long-term care. So you also need to know where it does it, because we discussed all the different places, and you need to know how long it does it. And that's based on them telling you that a mother has Alzheimer's, or that they have a strong history of sudden death in their family. But these are things that, in terms of a long-term care contract, you have to really look at it, because the devil is in the details in any contracts. And that's true for this one. So I want to go through some of the basic options. A lot of times you will hear people say, I'm going to self-insure. But I can tell you that most people who have accumulated a comfortable amount of money, they don't self-insure. Even some very wealthy clients that I worked with didn't want to self-insure. One, there was that cash flow. You know, they were well invested. And then suddenly pulling money out, which is how I got in the business. I had done a plan. It was the model for Vogue. She had a stroke, and everything changed in the way that we had things arranged. And I had to get a CPA and an attorney immediately to help us to deal with it. So savings is rarely a way that people will be comfortable, let's say. You look at the cost of insurance and you look at the cost of care. Now, we saw that some of the costs in this are pretty substantial. You may want to talk about leveraging money. What about HSAs? Anybody know why that's up there? I have some specialists in the group, and I have a feeling for the chapter watchers it may be the same. But a lot of people don't realize that anyone with a high deductible health plan, I think there's 3 or 4 exceptions, they can fund an HSA. Now, the HSA cannot be used for regular health insurance premiums, but it can be used for special insurances. Yay! Right, it can be used for long-term care. Actually, I worked for several carriers, so I have several products, and I actually use long-term care for one of them. Gee, this has gotten frozen. That's interesting. Well, my. Anyway, where was I? All right, so the HSA can be used to pay long-term care premiums. Let's move on to Medicare and Medicaid. We often hear, again, as an answer to what am I going to do to take care of this possible problem, we often hear the government will take care of me, right? You've been in the business a long time. How many times did you hear that? Right. And of course you went through, you can't choose where you go. You don't know that they actually will have the program at that point. We have shortage of facilities. We have a shortage of personnel. We have a shortage of everything, especially money. So for Medicare and Medicaid, I found a quote the other day. The Centers for Medicare and Medicaid Services, the CMS, announced on November 8th that it will increase Medicare Part B premiums about 6.7% for most enrollees in 2020. Yes, that would make the room very quiet. So those changes alone. Now, a lot of us have heard, oh, here comes a solution. They're going to add to Medicare Advantage long-term services and supports, right? LTSS is being added to Medicare Advantage. There's a wonderful thing. Again, I just want to read you what it takes to qualify for that basic qualification. Have one or more comorbid or medically complex chronic conditions that are life-threatening or significantly limit their overall health and function. I feel bad. We're talking about something sad and I hear the cheering in the next room. Sorry about that, guys. Or 2, have a high risk of hospitalization or adverse health outcomes. 3, require intensive care coordination. Now, the Medicare Advantage plans, because as you know, this is open enrollment. In South Tampa, where I live, there are 44 Medicare Advantage plans. 44. Just trying to pick one, you know, you could spend a whole day or more. But for the LTSS piece benefit being added to it, 2 things here. 1, the funding is very limited. And 2, the actual Medicare Advantage plan, the carrier who puts it out there, they have a lot of discretion as to how they'll do that. And they can change it from year to year. So you could change your Medicare Advantage plan from year to year. They can change some of the benefits from year to year. And it isn't set in stone. Doesn't sound like a very stable option to use for planning for extended or long-term care. I'm sure you would agree. Now, let's move on to the vets benefits. I didn't know a lot about vets benefits, but I had someone say to me the other day, I can use vets benefits. And I said, oh really? I was doing a function, a luncheon for veterans. And I thought, gee, I don't know enough about that as an option. Now, some of you may, especially the specialists, but I didn't. So I thought, okay, maybe that's right. Well, as it turns out, unlike the Medicaid program, you know, in Medicaid, they have no penalty. They have a 5-year look-back penalty so that there is a way to qualify. And part of that is financial. So you have to, I see everyone shaking their heads. Mostly everybody knows you'd have to divest yourself of X amount of money in order to even qualify. And so there's this 5-year look-back period. that says that if you transfer something to somebody or a trust, in other words, you divest yourself of this valuable piece of collateral, they can take it back into the equation. And for that number of years, and there's a formula where you take the number of years, the amount that they have to pay, and then it tells you how many months before actually your benefits would kick in. Well, that was never the case for the veterans' benefits until now, because now they have a 3-year look-back rule. And the person I was talking to wasn't even aware of that. And the new regulations set forth a net worth limit, of $123,600, which was the current maximum amount of assets in 2018 that a Medicaid applicant's spouse was allowed to retain. But in the case of the VA, the number will include both the applicant's assets and income. Yeah, so, and then there's some more to it, like who's eligible, whether it's a non-service connected vet or a service vet. I guess my point is, of these various basic options, probably the HSA is the only one that I consider something that we might easily talk to a client about, but we may wind up introducing them to the whole concept of an HSA. They might never have thought about using it to fund part of their long-term care because it is age rated. There's a limit depending on the age. But I have an example later that we can go through. So, insurance options. And I hope some of you are going, wow, 6 of those up there instead of just the hybrids and the traditional long-term care. So let me just get right at it. Since I have sold the individual policies, I think most of you have figured out that I was with 3 carriers and 3 brokers. I kept coming into the field to find out how really difficult this is, and then back to the carriers by invitation to try to help create products and sales. So the traditional long-term care market, obviously the amount of sales has come down substantially. And according to the 2019 Milliman long-term care survey, for 2018, 15 carriers reported a 13.1% drop in the number of policies and a 5.5% drop in the amount of new annualized premium. Well, that's not terrific, but what struck me was that it was 15 carriers, even if there were 3 or 4 more who didn't happen to report to the Milliman study. There used to be over 100. And I see people nodding their heads because a lot of carriers were in it. So now the market has, shall we say, come down to fewer carriers. But the products that those carriers are selling, especially in the traditional long-term care market, are really, really good. The other thing I wanted to mention was the effect of having the hybrid products, and we affectionately call them twofers, okay? And in Florida, I know that has a different meaning. You know, when they eat early at 4 o'clock in the afternoon or something and they get twofers, but this is not that, okay? So obviously, the hybrid policies and the combo policies have really taken over a very favorable market. But in the traditional long-term care market, I want to tell you that it has really, really helped the clients who do maintain their policies. The 2017, which was the latest figures I could get a hold of, the standalone long-term care industry incurred 11 billion, that's with a B, claims. 11 billion in 2017. And from when it started keeping track, in 1991 to 2017, anyone want to take a guess whether it's been 50 billion, 100 billion, 130 billion? Anybody? 130 billion has been paid out in claims. That never makes the news, unfortunately, but that standalone traditional stuff has helped a lot of clients. Now, while we're on the standalone, I do think it's wise for us to talk just a few minutes about premium rate increases. Why? Because remember we said you're going to be talking to a client and they may say to you, oh, I remember that stuff. My neighbor got this awful rate increase, or I read in the news, etc. That hearsay versus factual information. But in fact, there have been and will continue to be on those policies substantial rate increases. I have 3 policies. I've been with 3 carriers. So I can tell you that I have gotten rate increases and what happens when I get them. Well, first let's talk a little bit about why that happened, because this is something I think any client that you're discussing this with could understand. First of all, when they were first doing these late 80s, early 90s, they didn't know what to do for lapsation. So they looked at non-long-term care products and they said, okay, generally 5, maybe 6%. Well, in reality, I've never seen it above 2%. And in many cases, it's beneath 1%, even after rate increases. Nobody drops their coverage. Ladies, would you agree? This is a product that's very sticky. So it is, even with the rate increases, a product that is still very valued. The second unanticipated issue was, you know, we expect to be able to go through a low and medium and high investment rate environment, but that didn't happen. This is a very prolonged low investment rate environment. Therefore, the money they thought that they would earn hasn't materialized. And then, as we mentioned, the claims. When you claim early and your claims last longer, that's money that has come out of your investment pool. So those were the 3 biggest reasons that traditional started to have to do rate increases. So faced with the, the really unfortunate realities of the reserves being seriously underfunded, they've had to do the rate increases. What happens with the rate increase is that you get a letter, and the letter from the carrier usually gives you 4 or 5 different options to lower the benefits, to lower the premium, to shorten it, to lengthen your elimination period, so that you can find something that will continue to work with your budget. As I said, I get 3 different ones, but basically they all make sure that I will be able to continue with the product. There's even, for those who just don't want to pay any more premiums, there is a contingent non-forfeiture benefit that you can use that renders a paid-up policy for you. So now comes the fun part, right? Worksite. And the reason I say that is that was my specialty. I wrote a magazine article once a month on worksite. And I was especially adept at the executive carve-outs. With an executive carve-out, for example, when you sell life insurance, there is this is with an employer paying, okay? If you sell life insurance, can the employer buy you as much as he wants, or is there a limit? there's a limit. If your employer pays for your policy and it's a disability policy, and then you go on claim, the money comes out, is it taxable or non-taxable? Not true for long-term care. If you want to insure a particular class of people, say executives only, and their spouses, but you don't want to insure a different class of people, in other words, you're discriminating, can you? Yes. So for a executive, this is a very sweet deal. Now, with the core and the buy-up, you have the employer buy an X amount of money, let's say a $50 a day benefit, and then the rest of the employees can buy up. Now, what is that used for? Well, frankly, it's used as golden handcuffs quite often, because you buy X amount, they buy up. If they leave your company, they now have to take over the entire premium. So, and then voluntary, of course, as you can imagine, there's always the voluntary program. So now let's move to hybrids. Oops, sorry guys. And I felt that the easiest way for us to discuss hybrids, because we have limited time, is to discuss that you need to note which code, which section of the IRC code they're under. So if they're under the 7702B, this would be the riders, then the rider can be called long-term care insurance. If it's under the 101G code, it has to be called a chronic illness rider. So both of them, whether it's the annuity-based long-term care, that ABLTC, or life insurance with long-term care rider, they're going to be the 7702B. If it's a chronic illness rider, it's going to be 101G. Okay, so there's a very basic difference, and that's why there are different names out there, although one must admit that our industry finds a new name for everything. You think you have it, and then they slip and you go, what is that? And voila, it's another name for it. So I put this up. Now, as you can see, there's a lot of similarities in there as well. And at the end, when I get to the resources, I included 2 pages of resources, because this is page 1 of something that one of our companies puts out. So you can see that there are similarities, but there are also differences in that kind of coverage. And then there is, sorry, just gonna have a quick sip while you're looking at that. There are the extended death benefits, right? The EOBs. And why is that? Because consumers who were interested in these products then said, hey, what happens if I use my entire death benefit? And let's say it's $100,000. Well, we saw that the cost for long-term care can go above $100,000. So they wanted to know that they could extend the benefit. Now let's do a practical application, okay? So this is a client who you have to be 59 and a half older, and he's using a portion of his qualified funds to plan a strategy that may help protect the portfolio from depletion. Oh dear, wow, forgot about that part. And one of the people I work with, Zach, put this flow chart together in order to help everybody kind of go along with what I'm trying to communicate here. So you start off with the client, they carve out the $100,000. Now, of course, the client has to decide whether in fact they want to pay the current taxes that are due, because this is a qualified. You couldn't do this with a non-qualified, but nevertheless, taxes are due. They can either take it out of the $100,000 or they can take it out of their pocket. It depends on what the premium for the hybrid policy is going to be. This one we arranged for an annual distribution from the SPIA, because from a 401k, you have to get the SPIA. And the SPIA is used to purchase the hybrid LTC policy with a 10-year annual premium schedule. In this example, I assume that the premiums are guaranteed to remain the same and that the policy will be fully paid up in 10 years. The annual distribution, it's been leveraged. And that's what insurance is all about, isn't it? Leveraging money. And that's how we avoid so much risk. Everybody good? I can move on? Okay, time for a little audience participation at the chapters in here, because I know it's a long time right after we fed you, right? It's not hard enough, but then we fed you. So here's the case. Carroll is 48, a healthy non-smoker, did have some surgery, but it didn't make me uninsurable. It was only about, I don't know, $7,000 or something. And I want to purchase a hybrid. I will pass underwriting. Carroll's adjusted gross income is 110, and I'm purchasing it with $35,000 a year as my premium. Here's my premium breakdown. What will I be able to deduct? Right, so some of the answers are this portion here, more or less, is what I think I hear you saying. But I can't. You know why I can't? No, this is me just buying one. The reason that I can't deduct anything is because I'm 48, right? So that means I have to meet 10% of my gross income in medical expenses. And you see, I kind of slipped in there that I had surgery for $7K because what did I need? I needed 11. I need to have spent $11,000 in order for this to have been deductible. But as we saw, one of the options earlier, what could I have done to offset at least part of this premium? Right. And I looked up for 48, the allowable distribution would have been $790. So I could have deducted that. If I were 61 years old, I could have deducted $2,108 of the premium. This is true, but I was only talking about that little piece, but that's a good observation. So then it would really be important to have that deduction in there because there is a little bit more, although Carol's super healthy, right? So super top rate. Okay. The single premium annuity, we used it in our example where we wanted to create an equal 10 pay out of the annuity to match the 10 pay for the insurance. But it can also be used just simply for an uninsurable person. You create the leverage with their money so that they can use that to have home care, which is where everybody wants to be, right? And then short-term care. I bet you're curious as to why I included short-term care. Well, 40 states now have approved some form of short-term care. And there are two reasons I included it. Because sometimes when I was working with a client who, frankly, didn't want insurance, was uninsurable, or had too much insurance, I knew that if I had something like this, especially for maybe a grandparent or something because they weren't going to be able to have a cash flow that was going to work, it gave them a year or even 6 months to get organized because this wasn't going to last all that long. But during that time, remember, I worked at worksite. And for people at worksite, having 6 months or a year to figure out how to deal with this extended care situation is a real blessing. Anybody know what the other use can be? Augment Medicare Advantage. There you go. That's another good one. And if the price tag is a little bit high on the standalone long-term care for them, they can take a longer elimination period, and as a result, it lowers the cost. And then, you know, the home health care riders, I didn't go into great detail on that, but they are also out there. Oops, sorry, went a little too ahead. Hello. Gee, I really jumped, didn't I? Okay, so term insurance. Now, we all know that this accelerated death benefit endorsement has been out there, but you had to be chronically ill. They're now creating ones for, I'm sorry, you had to be terminally ill. Now they have them for chronic and critical illness. So now let's move on to non-insurance. When I first heard about reverse mortgage, I know we have Chris Bruza as part of our group here, but I was a little negative towards it until I really found out and read a book on it. And I can tell you that the FHA, the Federal Housing Authority, has now created something called a HECM, which is a home equity conversion mortgage. And in the home equity conversion mortgage, for example, some people are worried. They say, well, what if the loan starts to exceed the value of the home? What happens? Well, it's protected in the HECM. Just as if the market starts to go a little south, the lender is also protected. So I'm telling you, as a solution for someone who is asset rich, but doesn't want to touch maybe their investments with you, if they have a home, they might be eligible for a home equity loan. They do have to be 62 years or older, by the way. Life settlement funding. Thank you. Life settlement funding. Another thing that I think we heard about years ago, but we mix it up with viatical settlements. Viatical settlements are for terminally ill, 2 years or less. Life insurance settlements can be done through a broker or through an actual carrier that handles them directly. Suppose they don't have any heirs. Suppose they really, their family say, look, it's your money, and the children don't have the money to offer this person for care. They have the life insurance. In the right situation, you have to think about this instead of maybe a tremendous tax hit. Same with the reverse mortgage. They can get a line of credit that can be used, so if the market has, you know, really tanked and they don't want to go in and invade things and take big losses, they can access this line of credit and they can pay it back when the market goes back up. Why aren't you giggling? Are you that tired? I'm the one up here killing myself. Come on, guys. I mean, think of what I had to do to prepare this. Let's go. So, crowdfunding. Do you know that 10,000 crowdfunding GoFundMes are created day? And 1 in 3 are for medical, right? Shortages of help, shortages of personnel, people are maturing. And so they have gotten to be very popular. Well, we're at our wrap up at this point. You have your idea, you have your plan. We need some action. So what's happening on the state level? I'm just going to call out the governor of Maryland, who signed Bill 953, and he created the Maryland Task Force on Long-Term Care for Education and Planning. And I think we're going to see more states going in that direction. We need a little help in communicating this issue out there. I would also mention that Vermont, North Dakota, California are also all looking at this issue. And the National Association of Insurance Commissioners voted unanimously to create a task force focused on the long-term care market stability. And they also created a very significantly updated long-term care insurance shopper's guide. What's happening on the federal level? Well, NAIFA went to Washington. And what's significant here is the word interagency. And then yesterday, along with ACLI, NAIFA is continuing to work with the recently organized U.S. Treasury Interagency Task Force on Long-Term Care. I hope some of you saw the news this week because ACLI and NAIFA applaud Chairman Toomey's leadership in putting forth a proposal that would assist families to prepare for their long-term care needs by allowing them to have limited access to their retirement savings. CEO Kevin Mayu and CEO Susan Neely of ACLI wrote in a statement, "With this sort of flexibility, more families would have protection of retirement savings and be far better positioned to meet long-term care expenses." Yes, perhaps we have another one. So as Melissa said, we need you to be heard in Washington. And for those of you who deal with long-term care, NAIFA needs to hear about the issues, not just from members, but from your clients and from all people who are concerned about this growing problem. I keep doing that, don't I? I think I mentioned before, this is an area that is got such a scope. We went through about 15 options of various natures and various ways of approaching making sure that your client gets some sort of solution. If you give him a solution and it doesn't happen to be insurance, you don't think he's not going to tell people about it. You don't think that you're not going to wind up with a much broader audience, let alone your own book of business. And what if you really, really want to help somebody and bring somebody young into the business? This is a very good prospect for Gen Xers. It's provided all of us in the business with a very fine living. Plus, I'm sorry. Plus, of course, it makes you feel wonderful. The first time I got a call from a client who said, "I hope you go to heaven for what you did." I said, "Stop right there." I hope so too. And now, if it's not your specialty, right? We have specialists, lots of them. Now, I want to give you some resources. The LECP Center. NAIFA's LECP Center is growing in leaps and bounds. We have some wonderful sponsors who are helping us grow this center. It is an interactive hub. It's on your phones. It's on your computers. It's not printed. It's just what we expect to have over the next 20 years. Everybody is going to be on their computers. And we want to give them correct information, resources, etc. I am a CLTC, and I have to say that they give you a very broad education on long-term care. Some of those conversation starters or tips on what you should be hearing when you're talking to a client come directly from being a CLTC. My information is at the bottom here. I welcome from our chapter watching parties, from obviously Tampa, NAIFA, and from all of the individuals who may be watching at home. I need to hear from you what it is that you need to know. How do we increase the conversations? What do we say to Washington that would help us be better agents, service our clients better, and do more? And I would be remiss not to mention the LACP certification. Remember, it's a certification, which is important. And it shows that you have a possess knowledge and experience, but you're a committed professional. And then I have to mention the ILTCI, that's the Intercompany Long-Term Care. Because, one, I'm on the board, and why? You saw that I have a bunch of designations. You know what that should tell you? I like to learn. People who have designations, maybe they are smarter than I am. But for me, I like to learn. So I go to the intercompany. There are 8 tracks. That's how I know when I speak to the actuaries about the new products that they're designing. They now have credible information. So they're not building in a 6% lapsation rate. They're staying with a 1 or 2% because no one, once they have the coverage, is willing to drop it. So I thank you for staying awake and staying with us through this. And I want to thank all of you for coming today, especially thank the chapter execs for having me. And if we have any questions, I would be happy to answer them. We have about 6, 7 minutes.
I have a question for you. Do you think there's a way that we could put all of this amazing content that you just shared with us into a short head-size version of it for the Gap community or for the Gap people?
Thank you. That's a great
We can do a happy hour,
suggestion.
10, 15 minutes and just
I will work personally with you on that. How's that? Because I think that's a great idea. You know, when you do CE like we've done today, you have to have 50 minutes minimum. But that's what I'm, right, I agree with you. Thank you, by the way. I will work with you personally and we will get that done.
So again, if you've never done this before, what tips would you have for someone to start with this? What I've never done long-term care before. What should I do? First few things I should do.
I think the first few things that you should do is start to look at the clients as you're dealing with your clients, right? Because I think understanding how to listen when you're with clients is key to understanding which option. And once you don't talk about a product and you're talking about what is important to that client, that leads you to say, okay, this is a risk for them. No matter how well we've done with wealth management or with life insurance, etc., if you haven't done this, it could all blow up. So I think you start with understanding how to listen, and that's why I put that first, and why I put some conversation starters. And then you decide if the answer, if the option is not the one that you're an expert at, let's say that it's the vets, right? I just didn't know enough about the vets. I went to one of the resources that you've seen up here. We have an expert in there. Speak to the expert. I don't think any client ever rejected any of us because we said, you know, that's a thought. Let me look into that because I really want to get the right research so that it's current, that it applies to you. The minute you realize that you're really making everything about them, makes you a better person, but it also means you're probably going to do business with that person. So for me, it starts with the person, then it goes to, do I have the expertise? And then it goes to choosing an option that's going to work for them long term. Because remember, premiums last for as long as they do. Anyone else? We have about only 1 more minute. Okay.
All right, well, thank you, Karen.
Thank you.
All right, well, thanks so much. That was very informative. And if anyone who's ever helped anyone, not only sell long-term care, but help them go through a claim, then you get a real appreciation for the value that you bring to families. I'm telling you. So with that, I'm going to kick it back to Zach in Falls Church so that he can do a polling question for our virtual viewers.
All right. Well, thank you, Bill. Thank you, Carol. And thank you to all who have participated in today's NAIFA Live. And now we have another polling question for individual viewers. The next polling question is, drum roll please, how many years have you been in the business? I'll repeat that. How many years have you been in the business? Please use the polling function on your screen to respond. You have 2 minutes. Now, don't forget to mark your calendar for the next meeting on January 9th, featuring Curtis Kersey, hosted by NAIFA Ohio and NAIFA Cincinnati, and sponsored by Emeritus. For those of you who have joined us virtually, this concludes our program. For those of you who are participating from area viewing locations, we turn you back to your local meeting and encourage you to continue today's discussion. On behalf of NAIFA, we wish you all a wonderful Thanksgiving, and thank you for being a member. Have a great day.